Good morning and how do you do, ladies and gentlemen? I'm your host, Seth Julian. Welcome you to today's session where we are going to take a look at the beginnings of the earnings report season. As you know, last week the official season kicks off with, of course, the major banking institutions, and that's for good reason because the banking institutions are the fuel stations, the source of capital for much of industrial society. So we look at the banks to get a reading in general about the robust or lack of robust health in the economy. What I want to point out is a phenomenon that we saw late in the day on Friday that concerned many of us, myself included, and that's this bar. We're looking at Citibank here, but it's the same for J.P. Morgan, Goldman Sachs, Wells Fargo. It's all the same. This is a 4-hour chart. You see this long bar with a very long tail, and I'll show the rest of them, but they all are printing the same pattern. There was a big dip on the release. Now that is contrary to what we expect when you see that for the quarter the stock is up, the bank expectation for the banking industry was positive, and they did come out positive, etc., etc. Stock should have popped, and eventually it did. But that's that eventually business. You had to have a lot of nerve to hold on for this trade to work out. Not a lot. It looks to me like about 5 hours worth of nerve. Well, I take it back. You see here in the beginning, it was indecisive. Long tails, short bodies, meaning there was a battle between the bulls and the bears with an indecisive outcome. Here also the battle raged even much wider and farther, and in the end it turned out positive. But Friday afternoon before the close, it wasn't looking so positive. Point is this: the reports tell us what's going on. If you look, and this is Citi, a famous bellwether in itself, one of the world's largest banking institutions. Let's take a look at Wells Fargo. You'll see the same pattern. He's that long, wacky bar. It only ended up very, very, very luckily, fortunately, at the very end of that bar on the positive note. There was a lot of, and you see the volume popped. It was a panicky time last Friday, as those of you who were watching those reports release, well know. We took a look at Citi. We saw Wells Fargo. Let's take a look at J.P. Morgan. You'll see, as I say, it's all the same. I'll give you the 4-hour. It's all the same. See that wacky bar? That was a big panic attack in the market, and it was frightening to attend if you were trading. We looked at J.P. Morgan just now. I think so. Yeah, they're all the same. They're all the same pattern. And my point is this, and it's quite simple. The banks did well, but remember, earnings reports are rearward looking. They're historical. They're snapshots in time. They don't predict the future. They only show you the past. However, during these reports, the banks or all corporations make an attempt to tell you what they think the future is going to look like. And they told us the future ain't looking so good. Loan loss provisions have increased by something on the order of 20%. What is a loan loss provision? In accounting, if you're expecting a debt not to return, not to be paid, you have to provide for that in the books and allow for capital that you have that would have been normally considered profit as loan loss to cover the loans that are not going to come back to you. Loan loss provisions are up. Expectations of bankruptcies are up, and there's a general sense that not a sense. It's a prescription that these banks are all holding. That sometime between the second and fourth quarter of the year, there's going to be a recession in the U.S. economy. And that's going to slow lending down. Remember, these guys make their money in a simple, straightforward way. Banking is not a complex industry. I pay you 2% for your deposit, and I loan it out to her. It's 5%. That difference is my profit. That's all there is to it. And of course, when the system was so bolted down to the ground, when interest rates were 0.25%, nobody was making any money. Nobody was getting any money. It was a wash mostly for the banks. They could only make money through trading and mergers and acquisition, of which there was a great deal. But now with recession at our door, mergers and acquisitions and trading is a much tougher game, and so they stand to make more money by extending loans. because the spread has widened. But now that the recession is on the horizon, loan demand is going to fall. So it's not going to look so good for the banks. And that's why we saw this anomalous positive outcome, a positive outcome in the earnings report, yet momentary dysfunction or a misreaction by the markets. Now, they did catch on and behave as we expected, but there was a scare, and we're going to see more of this as the earnings season unfolds. So, ladies and gentlemen, that's our prognosis for the day. The banks are up. There's still good buys. If you held on and you had the nerve to hold on for those few hours, the trade did work out, but it took an extraordinary amount of nerve. And we're going to see more of this during earnings report season. We're going to see companies who profited in the past, who were profitable in fiscal year 2022, who are looking at much, much choppier, if not profit-free waters in 2023. And that's why we're going to see a continuation of a decline in the stock market worldwide. So, ladies and gentlemen, that's going to do it for now. I'm your host, Seth Julian, wishing you all the ability to trade with confidence. Bye-bye for now.